Hello there, this is James and you're watching Tixee Live, and a very good afternoon to all of you, and all of you a very happy Thursday. In today's program, I want to have a little chat about how the market at the moment tends to listen to what it thinks the Fed is saying or what it wants to hear, and not actually what the Fed is actually saying and the implications of that. Plus an update or follow on from obviously the new the autumn statement from the Chancellor of Exchequer and the impact that has had on the sterling today, and basically recap what's going on in the market. But before we get into all of that, don't forget these little videos are for educational purposes only, and in no way whatsoever should they be taken as financial advice. So I always suggest you do your own research, do your own due diligence, and of course, know the risks at hand before entering any trade. With that out of the way, let's get started. So, indeed, we've had an awful lot of Fed speak over the last couple of trading days. Like I said in this morning, we had one pretty dovish comment, but not really dovish. It's what markets thought was dovish. But anyway, it's like watching a reality TV program, because every now and then the market sort of wakes up to reality a little bit. And we are seeing at the moment, after several very impressive days of gains, we are seeing the market sort of, ending on currently on a losing streak for today. Okay. And that's the reason for that is pivot hope has faded again, which I don't understand how the market keeps anticipating a pivot. And there's a new reality coming into play here. And all joking apart, I'm not surprised by this statement or what I'm going to read out in a minute, because Jay Powell or Kapow said something similar several weeks ago at the FOMC press conference, which the market paid attention to, but has since forgotten all about since the recent CPI readings. But anyway, Jim Bullard, who is very hawkish, okay, he said, thus far, the change in the monetary policy stance appears to have had only a limited effect on observed inflation, but market pricing suggesting disinflation is expected in 2023. The policy rate, as he goes on to say, the policy rate is not yet in a zone that may be considered significantly restrictive. To attain a significantly restrictive level, the policy rate will need to increase further. Now, what he's basically saying is that where the currently interest rates are at the moment is not having that bigger impact on inflation currently. It's not shaking the barley, so to speak. It's not having that massive impact on inflation. And that they're going to have to raise interest rates further. And funny thing is, at the FOMC press conference several weeks ago, Kapow said the same thing. Now, every Fed member at the moment is saying or are hinting at slowing down the increase in interest rates. So everybody expects 50 basis points. Don't forget they've done 475. They're expecting 50 in December. But not once has any Fed member said they're going to pause or they're going to stop. Not once. And here's the thing, and this is worrying, okay? Bullard suggests the proper zone for the Fed fund rate could be in or between 5 to 7%. 5 to 7%. Okay, 5 to 7. That is frightening, because that, no doubt, will have an impact on inflation, but that, especially anywhere between 5 and 7, even imagine if you go up to 7, will have a massive impact on the US economy, a massive impact. So that's the reality of it. The Fed's not going to stop. The Fed is not going to pause. They're going to carry on raising interest rates. When they're at the level, they'll probably keep it. They're not going to reduce, because the market keeps thinking that at some point next year, they will start reducing interest rates. They've never said they will. They have said they will increase it more. Yes, maybe by smaller increments or smaller bites, but they're not going to stop. I mean, like I said, we've had so much Fed talk today. Fed's Mary Daly, who is a bit dovish, she said she sees the rates range between 575 to 525. Okay, not as scary as Bullard's 5 to 7, but 525, because the market has sometimes gets itself into the impression that the Fed will get to 5 and then we'll stop. We'll stop, but they haven't said that. Very true. Very true. Yeah, bond yields are up in the US again at the moment. Are up again. But yeah, and very true. But like I say, that whole point is they're not going to stop at 5. Unlikely to stop at 5. And the market doesn't seem to listen to it. They like to hear what they think they want to hear. And it's not really the truth. You need to bear it in mind. JP Morgan Chase predicts that the US will enter a mild recession next year, and that will cost 1 million American jobs. 1 million American jobs. So like I say, JP Morgan also said this. They said this yesterday, and they also said they think the Fed is going to stop at 5, which I don't think the Fed is, especially after what Jim Ballard just said today, 5 to 7%. No. So anywho, let's have a quick look at the market, and then we'll have a talk about obviously the UK budget announcement as well, and the impact that's had on the sterling and the market at the moment. So let's have a quick look at the market. So this is obviously the S&P 500. Like I say, we were trading, it's slightly negative. Okay, it's not like dramatic everything sell off, but it was trading around 3,969 points, currently trading 3,919. As you can see, we've had several good days of gains. Today is slightly trading lower. If we can have a look on a 30-minute, I see obviously, it's trying to bounce back because it came under pressure following, Bullard's comments, which is really scaring the market, or waking the market up to it. The NASDAQ is open the same again on the day. Again, trading lower on the day, 11,615 points. Still that key area for me potentially is 12,025 points. If we have a look as well, because this has actually had an impact on the US dollar as well, of course, obviously. Well, like I say, they've always been hawkish. I don't think they won't do 75. I think it's all priced in there to do 50. But the idea of them stopping, I think, is ludicrous. I think the market's really got that wrong. And the market continues to get that wrong. So say it's not just obviously the indices. We've seen a strong dollar across the board as well today. So the this is on the day. Seeing the euro is down now, trading at around about 1.03392. So that's come under pressure with the dollar as well, because of basically what Bullard has said. So we've seen a little bit more of a fight back with the dollar today as well. And obviously dollar yen. Dollar yen is the same. We have a look today. It's been obviously stuck in a pretty tight range over the last couple of trading sessions. Dollar's beginning to fight back slightly. Now, we were trading the beginning of the day, 139. We're now back around about 140.42. We'll have a look at the sterling at the moment, but I'm going to talk about that first. Gold, again, because of the back of this, bond yields have obviously gone up. So that's hurting the yellow metal currently at the moment. Currently trading slightly lower today. Again, it looks like it might be a day of losses again for the yellow metal. Currently trading $1,761.28. So yeah, there we have it at the moment. But anyway, let's have a quick update. We talked about obviously the autumn statement today in the beginning of the session. Poor gold. I know, don't worry. I think it'll be okay. We talked about the autumn statement due today with Jeremy Hunt. I've always got to be careful when I say that name. Talking to Parliament today, and then giving his obviously his fiscal statement. Jeremy Hunt has actually said, has announced, but pretty much what we were anticipating, we were expecting something like this: 55 billion in tax hikes and spending cuts. He's actually raising the highest. It's actually lowering the level for the highest rate of income tax down from 150,000 down to 125,000 and 100. Now, okay, we also knew we had to do that. This is obviously polar opposites to the fiasco we had, over a month ago. A total fiasco which we had over a month ago. Total polar opposites. But this does mean as well that the UK, who's already in a real tough spot, this is going to increase financial hardship on millions already dealing with the cost of living crisis. And as well as that, obviously, he has admitted, which we all knew already, that the UK is indeed in recession. The Bank of England, don't forget, has said that this is going to be the longest recession the UK has ever experienced since records began. So that is pretty scary. But again, we knew he was going to have to do this, complete opposite to the fiasco of 2 months ago. But again, like I say, we haven't seen, we'll pull up the sterling in a minute. We haven't seen the dramatic crash or the drama after the last time we had a mini budget. But still, sterling is still not impressed. It is not impressed. UK interest rates going up. Yes, they have to. They will have to put interest rates up. I predict. Well, I think they're doing a 50 basic point rate hike in the next in December, which is when the next Bank of England decision, interest rate decision is. They have to do. They'll definitely do 50. They did 75 last time. I think they'll do 50 this time, because they have to bring down inflation. Inflation is at 11.1%. If it wasn't for the government support with the electricity bills or the energy bills, inflation would be 13.3. But because of that sort of minor support they're getting, inflation is currently at 11.1, still frighteningly high. So yeah, they will do interest rates. They will go up. They will have to. Okie doke. So anyway, the sterling's not impressed. Let's have a quick look at the sterling while we're at it. And the euro sterling as well. Okay, like I say, on the day, it's down negative. I mean, it's like I say, if you look at the short terms, it looks slightly more dramatic. Obviously, it was trading around here, 1.11948 at the time of obviously the fiscal statement announcement. It has dropped. It's now currently trading, though it's recovered. It went down as low as 1.1763. But it's currently trading now at 1.18150. So slight fight back. I also think this is beginning, the other reason for the drop is what we saw it with the euro as well. We are seeing the dollar come back a little bit as well. So that's the other thing. So not impressed. So key level, potential area of interest, potential support, 1.17630. So do you think the government and Bank of England will continue to work together, or was that just to help the trust? They will, actually. Jeremy Hunt did say in Parliament, he praised Bank of England's hard work so far and his trust in them and their independence. So the government will carry on. I mean, that's a pretty much full-blown, backing there by the government to back the Bank of England. I mean, the Bank of England has done, not done awful, but they face criticism about raising interest rates too slowly. They were the first central bank to do so, but they have increased rate quite slowly, not as bad as the ECB. But if you compare them to the Fed, where the Fed's been very aggressive, Bank of Canada was aggressive as well. Even the Reserve Bank of Australia was aggressive. The Bank of England sort of tiptoed around interest rates a bit. So they have been criticised for that. But in general, they've done the best they can, because they can't remember that they can't do what the Fed can do. Okay, the Fed has got a pretty, at the moment, though there's evidence, especially in the housing market, that's beginning to creak. I keep talking about the housing market, that's beginning to creak in the US. But unlike the US, the UK doesn't have a robust economy like the US has. The labour market is still very, very strong. For example, initial claims came in still low, 222,000, compared to the expectation, 228,000. So again, labour market is still pretty robust as well. So whereas the UK, we know we got economic slowdown. We're already in recession. They're already in recession. So the Fed has to be really a lot more careful. With the Fed has got a lot more tools in its power kit than the Bank of England has. Let's have a quick look. Good question, though. Let's have a quick look at the euro sterling as well. Again, like I say, Initially, obviously, the euro has only got a boost because, like I say, the sterling bulls were not impressed with the budget, even though they pretty much anticipated it was exactly really what we thought it was going to be. So there was no real surprises. Currently trading at 0.8755. Other major events happen a week. Well, tomorrow we got UK retail sales is the only real thing, but realistically, it's probably going to be more Fed speak. There's plenty more Feds to speak over the next trading session, obviously, and obviously to see how the US session carries on at the moment and how much talk or how much the market listens to what Jim Bullard said about interest rates going between 5 to 7% in the United States. The market equities as it currently stands, S&P in the red, negative 1.23%. NASDAQ currently negative 1.24%. Dow 30 currently negative 0.80%. A complete polar opposite to what it was yesterday, same time when we were speaking about the US session then. So there we go. There we have it. Don't forget, like I say, just Orford and SMF 790, you can ask me questions or say hi anytime at all. You're more than welcome. Or just simply say hello if you like. Or share with me your opinions and what you think. Like I say, look, there's clear signs that the Fed, I can see I'm at a bear market rally, like I said the other day, in a couple of things at the moment. I don't think it's time of a bull rally. I think it's bear market rally because I really think the market keeps kidding itself that when they get to 5, the Fed will stop. And I don't think the Fed will stop because even year on year, 7.7%, which was the last number, that's still way above their 2% target. And like I say, core is still 6.3. And that's only the low it was 2 months ago. So we're not out of the woods yet. Are you looking closely at the US housing market? What other indicators do you look out for? Building permits, obviously. New house starts. Their house starts are beginning to decrease lower. I noticed today. Building permits but also seem to be a little bit of strange, a little bit under pressure. And clearly there is issues with the housing market, which is going to be understandable because mortgage rates are up, makes mortgages more expensive. It's going to be more strain for homeowners. So it makes perfect sense. But yeah, like I say, building permits was today, housing starts, both were pretty disappointing. We're not great, we're not awful yet, but it's still showing signs that, there's cracks beginning to begin, definitely. What do you think bottom of S&P is? What do you think the bottom of the S&P is? Good question. I think, again, this is not financial advice, obviously, and this is backed by many people. I reckon around about the 3,000, I don't think this level, I think actually, we look at it, yeah, definitely 3,520 area, potentially, by the end of the year, if this bear market rally runs out of steam. In fact, I'm not the only one, actually, who's looking at that region. 3,300, 3,500. Actually, what's his name? Michael, what's his name? The analyst I follow all the time. He's Morgan Stanley, very highly regarded. Cool, you reckon 3,300 points? It's not far off, actually, because let's say there is still some bears out there actually thinking that. Michael Wilson, that's the name of the guy, strategist for Morgan Stanley. He thinks around the 3,500 to 3,000 level by the end of this year. So he's thinking there's going to be more drops to come with that. Like I say, he thinks this is a bear market rally at the moment, like a lot of us do. So yeah, 3,300. Yeah, that, like I say, potentially, possibly. Obviously, I can't. Nobody knows for certain until it happens. But there's a lot of people bounding around 3,500 to 3,000 points by the end of the year. So yeah, that's the sort of level a lot of people are thinking, potentially. But like I say, we've got so much ground to cover. December's going to be interesting, obviously, because before the Fed makes its interest rate decision, by then they will have the job number before that, and they will have the inflation reading before that. So then that's when their decision can be formed based on that information. So that'd be really, really interesting. Good questions, though. Good questions. Don't forget, if you think of a question later, nice one, JT. Oh, thank you very much, buddy. Really appreciate it. Thank you. Don't forget, if you think of a question later, you can put it in the comment section, either on YouTube or Facebook. I will see them and I will reply to them next time I go live on air, which should be tomorrow around about 9:30 a.m. UTC to discuss the obviously the European session and it's open. Then around about about 1:30 p.m. I've got another hashtag Ask James episode tomorrow, which I'll talk a bit more about tomorrow. And of course, again tomorrow at 3 p.m. or around this sort of time, 3 p.m. UTC to cover the US session. So please come and join me for that. Shout out to Paul, SMF 790 for your great questions and your interaction. Really appreciate it. And thank you all of you for coming along to watch me. Now, like I always say, if you're watching me on Facebook and you enjoyed this little video, by all means, give us a follow. If you're watching me on YouTube and you enjoy this little video, subscribe if you like. Hit the notification button so you know next time when I'm going live. If you enjoyed this video, found it interesting and useful, and you put up with me, then give me one of these. It's nice to know that you like what I do. Anyway, till next time, don't forget, these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research and do your own due diligence. And of course, know the risks at hand for entering any trade. Till next time, every single one of you, trade safe.